What's up, everybody? Market has been selling off, but I am continuing to buy stocks every single week that I can, or at least every month that I can, and being very transparent. I just put $2,000 into these 5 stocks: Airbnb, Mongo Database, Shopify, Mercado Libre, and Build.com. I'm going to talk about why I bought these stocks and why I think, and I continue to just buy stocks even though the news is all negative, the sentiment's negative, and so many people are predicting that stock market's going to go down. We're going to enter a deep recession and everything's going to crash. Okay. So first of all, the news has not gotten any better this week, right? It's, I don't know, Tuesday or Wednesday, whatever day this is. And the market's up, right? We're seeing all this bad news. We've got Hurricane Ian out there, which is hitting us in Florida right now. And if whoever's impacted by that, stay safe. We're on the northeast coast of Florida, so we're doing fine. Thanks. I know you're all worried out there. Don't worry, we're safe. But look, Stanley Druckenmiller sees a hard landing in 2023 with a deeper recession than many may expect. Bank of England intervenes in bond market after the historic sell-off. We saw the news that Apple is essentially decided not to produce more iPhones than they were initially planning. So there's questions about demand. And I think Apple's stock is probably down today, I would guess. Yeah, the stock's down 2.76%, which I just did a video a week or two ago. Search it on Apple that I think Apple's overvalued, but aside from just that, right? So the question is, I guess, is why am I adding stocks here? And so first, to be transparent, I'm building this portfolio right here on YouTube. We started with $10,000 February 16th, 15th, 2022, and we're building it to $1 million. I'm sharing every step of the way, just to help people learn about investing and share what I'm doing, not to recommend anyone else follow I do by any means. So we're at $94,561. Today we're up $2,300 on the week, which is, I think, over the last 5 days. Yeah, since September 21st, we're down $4,800. And then all time, again, this is since February 15th, we are down $10,800, okay? So this is a long-term portfolio. We're down right now. I'm not concerned. This is a portfolio that I want to hold everything I own for at least 3 years, but I would love to own the stocks I own for 10 to 20 years, as long as they continue to execute and do well and don't get extremely overvalued like they were back towards the most part of 2021 and the end of 2021. But we're nowhere near there now. So here's the portfolio. If you wanted to take a look, it's the same companies as I've had, haven't made any sells. I've just purchased these stocks that I talk about, which I'm going to go into why and show you the valuations and why I think that this sell-off has presented a good opportunity and why I'm adding to these. And really just to cover that, right? What I'm doing is I'm starting to move all of these companies towards relatively the same position size, right? So we see that Snowflake is a 13% position in the portfolio right now. And the smallest companies, Shopify, Mongo Database, Mercado Libre, Build.com, and Airbnb, are right around 4%. Well, those are the ones I just added to, right? So you can see this dark black, the bold black number, 7%. That's the target percentage. And you can see I've set pretty much all of them at 7, with the top positions at a target size of 8%, right? And so the portfolio, as money comes in, just automatically invests to bring everything closer to its target size. But it's not going to sell Snowflake. It doesn't rebalance by selling. Since I'm adding, it rebalances by buying more of the stocks that are, under their target size. So the target size is 7% here. These are 4.5%. So these are the ones that are going to get the money until they get up to about 7%, and then it'll add to whatever else, okay? So why am I doing that? Why do I do that? I think we can get ourselves in a lot of trouble, especially for individual people out there who aren't professional investors, which is 99% of us. We can get ourselves into a lot of trouble by over allocating and being too excited about any one stock, right? So if I'm super excited about Snowflake and I put 25% of my portfolio in there, if Snowflake gets cut by 50%, or God forbid some type of bankruptcy or something, which I'm not worried about with Snowflake, but that happens in companies, then your portfolio is completely destroyed, right? If anything happens to a single company, you can get really, really hurt if your allocation is too large. So by having them all around 7 or 8%, I'm comfortable with that number. And what that does is, if a stock really outperforms, and say Snowflake does twice as good as Datadog over the next 5 to 10 years, well, then the position size will be about double the size of Datadog. And, I would be comfortable as the portfolio gets larger of having a 12, 13, 14% position if I only put in 8%, if I only contributed up to an 8% position. So that allows the companies to grow without me adding more money to them because I'm just overconfident or I think I know something about this company. So anyways, I like this idea of having these set kind of targets relatively the same, because that takes less time to think about exactly what size I want each position, and I can focus more time on just having the stocks in the portfolio that I am comfortable owning, a 7 or 8% position size in. And if a stock is super risky and I'd only be willing to own 1 or 2%, I probably don't need to be owning that stock anyways, because it would take a 500 to 1,000% return, a 10x essentially, before that becomes actually like a meaningful position in the portfolio. And those can work out sometimes, but when you do that, all of a sudden you might find yourself with 10 1% positions that are in high risk companies that end up not working out. And then even though each one is only 1%, because you have 10% of your portfolio allocated to these high risk companies, maybe 8 of them don't work out and you've just lost 8% of your portfolio. Now, the other side of that is if just one works out and it becomes a 10 bagger, a 20 bagger, a 100 bagger, well, then that's life-changing money. And some people like to do that. I just am comfortable based on the valuations of where these stocks are at and what I think the growth potential is for these companies and just cloud in general. And then, specifically with Rocket Lab and Tesla, they're not really cloud stocks, obviously. I'm just comfortable with the return potential of these stocks and having them at 7 to 8% position sizes, and then just kind of letting the stocks take care of themselves. So anyways, I don't react to macro stuff. I don't know what's going to happen with interest rates. And even if you do know what's going to happen with interest rates and are we in a recession or not, I think we are probably in a recession. Data shows that by the time data actually shows that you're in a recession, that's actually the time to be buying stocks, not selling. You want to be selling stocks 6 months to a year before a recession because the market is forward looking, right? The problem is it's impossible to know 6 months to a year ahead of time that you're going to enter a recession. And so you could approach that 2 ways. You could try to time it and be in and out of the market. That's just not what I'm going to do. Or I can try to buy great companies, hold them long term, and do my best to avoid buying them at excessive valuations, which is what happened with a lot of these stocks that are down 50, 60, 70%. The valuations got way too out of whack. We don't need to try to time a recession or try to time macro indicators or interest rates or anything like that to avoid owning stocks at excessive valuations. And what do I mean by that? Well, we're just looking at the S&P 500 right here. In December of 2021, it got up to a PE of 24. Show me another time other than in the past year, really, where the PE was at 24 for the S&P 500. And you can't really find it, at least not in the last 20 years. And so if we avoid excessive valuations based on where things have historically traded at, then that's a way to safeguard ourselves from, getting really, really hurt, which is a lesson that I have learned from 2020 to 2022. The lesson that I don't think we need to be worried about is that we should avoid owning all of these stocks altogether now after they've sold off down to now the S&P 500 is at a PE of 17, which this blue line shows its normalized PE over the last 20 years. It's below that now. I have certainly not learned the lesson that when things get undervalued historically because there's fear out there in the market and we're in some type of macro downturn to sell everything. That's not my takeaway from what's happened. And historically, history shows that that's actually not the right thing to do, right? I mean, going into 2007 is what we're looking at right here. The PE was at 20, right? And so the price to earnings multiple contracted all the way down to 16 or 17, or we'll go down to 16 after the great financial crisis, right? That's a 20 to 25% reduction in price to earnings multiple, right? That's about the reduction that we've had now. So it's gone from 24 down to 17. So we've actually had a greater reduction in price to earnings multiple now than we had in 2020. Now, why did that happen? Well, that happened because the S&P 500 actually fell more, but earnings actually dropped a lot more because we were in a significant recession, right? So we went down from a high of earnings per share of 802 to 439. So that's certainly a risk here, right? Like earnings could definitely drop. I don't think that we're entering a once in a 50 or 100 year type of financial crisis like 2008, 2009 was. People are saying that we're going there. I just don't bet on those things because they only happen historically once every 50 to 100 years, right? And so to be betting on that to happen now, some people, maybe that's what happens, right? But data and history and probabilities show us that that's not what this is, and this is most likely just a normal recession, which there will be some type of dip in earnings, but nothing like what we saw in 07, 08. I could be wrong on that, but that is what data and probabilities and history show. It is unlikely that that is what we're entering right now. So knowing all of that, for me, now is the time to be buying stocks versus selling, right? If I was going to be selling, it was going to be up at a PE. My lesson learned would be to sell at a PE above historical averages, right? Or at least avoid continuing to buy there. Well, we're nowhere close to that now. And so I'm focused on buying. And obviously the companies I own are down big from their all-time highs, right? If we go to the companies I just bought, this is Airbnb, Mercado Libre, Shopify, Bill.com, Mongo Database. I've owned these already. I'm just adding to them again. This right here shows, year to date, Airbnb down 36%, Mercado Libre down 40%, Shopify down almost 80%, Bill.com 48%, Mongo Database down 63%, right? So these things clearly were way overvalued, right? But we're beyond that. We're not there anymore. The multiples have come down a lot, and in my opinion, they're very reasonable now if you're investing for 3+ years, right? And why? Why do I think that? Well, just looking at Mercado Libre and Shopify, even with these drops, this 80% drop in Shopify and this 54% 1 year drop in Mercado Libre, over the last 5 years, Mercado Libre is still up 200%. Shopify is still up 137%. Over the last 3 years, Mongo Database is still up 65%, right? If you own the right stocks and you own them long enough and you buy them at decent enough valuation multiples, I'm never going to time the bottom, and they still might be a little bit overvalued over the short term. But we're looking for decent enough here. If you do that, it's going to work out great over time. That's my approach, and I accept the fact that I'm going to be invested through downturns and recessions. My focus on that side is to continue earning income and gaining skills and be able to continue investing and not have a bunch of debt and increase my living expenses as my income goes up. I want to increase my savings rate, not my living expenses or my cost of living, right? Those are ways that I try to combat the macro cycles. I do that on the personal finance side, not on the investing side, right? Because I just think it's impossible to time. And if you're always trying to time the macro cycle, then you're never going to be invested because there's always fear out there. There's always something going wrong, right? So anyways, we're talking about gross profit margins of 81% for Airbnb, 51% for Mercado Libre, Shopify's at 51%, Bill.com's at 83%, Mongo Database is at 71%. And then in terms of revenue growth, right? So the 5-year compounded annual growth rate of Mercado Libre, revenue has grown 53% at a 5-year CAGR. Shopify's grown 58%. Mongo Database has grown 54%. Just incredible 5-year growth, right? Over the last 3 years, Airbnb 18%. Mercado Libre, almost 70%. Shopify, 56%. Bill.com, 80%. Mongo Database, 46%. Just elite growth, right? Revenue growth looking forward. And these estimates might come down, right? I accept that. But I think the runway for all of these companies, for Airbnb and travel and essentially leisure, right? That's going to pick up. And there's such a big market there. And clearly they've got a dominant platform, right? I think there's a lot of growth ahead. So even if these come down over the short term, I think long term there's enough market there in every single one of these cases, right? So 41% expected growth, 49% growth for Mercado Libre and Shopify. We're talking about e-commerce. Most of the world's commerce is still done not online, and these companies are in payments, logistics, e-commerce, and they're just going to continue to adapt and evolve, in my opinion. And so, I just think there's a lot of upside for both of these companies, simply because of the tailwinds of the industries that they're in, and they're leaders in that industry, right? Bill.com, revenue growth forward 75%. They do essentially like back office, admin and expense operations and payroll and things like that. Most small businesses still do their payroll through mostly manual processes, right? The market opportunity for Bill.com, if they get it right, is so large that even if they miss these forward revenue growth estimates, there's enough potential runway there that if they keep executing, I think things are going to be just fine, and they're going to have so much more revenue in the future that if we're off right now on the multiple, I'm fine with that because of how much it's come down, right? And MongoDB is the same thing, right? Essentially, new database requirements are being built on MongoDB, right? Just because of the evolution of technology and how applications are evolving. They've become a dominant player in the industry. They've been up against AWS and their offerings and a lot of other competitors, and they've grown a pretty significant business and a good reputation. And I think they're going to continue to do that and win more and more workloads that start using MongoDB, especially their managed service, which is called Atlas, right? And I'll go more in depth on each of these companies. So if you like this video, just like the video and then subscribe to the channel so you keep getting updated. And finally, looking at a valuation metric or a multiple metric, the enterprise value to sales forward looking, Airbnb is at 7, Mercado Libre is at 4, Shopify is at 5.5, Bill.com is at 12.5, and MongoDB is at 10.3. And just to give you one example of how much these come down as these companies grow, right? Let's look at Bill.com and let's look at these earnings estimates, right? So 2023, 2024, 25, 26, and 27, right? These are going to be wrong, obviously, because they're so far out, but it gives us a frame of reference, right? So we've got a forward price sales for 2023 of 14. Well, that comes down to 10 in 24, 8 in 2025, 6.7 if they're at around 20% growth by 2026, and 5.4 if they're at 23% growth in 2027. The thing is if that revenue growth, if they keep growing revenue, this number keeps getting smaller, which is how the company is valued essentially. And so in general, somewhere in an 8 to 10 range is fair, right? And so what that means is that, the forward price sales ratio in 2027 would probably be higher than 5, given this revenue growth estimate. And if it is, that means the stock price is going up from here, right? If they hit it's an oversimplified way to say it, but that's how these metrics work. Now, if the company starts to fail on execution, starts to see more competition, margins come down, they can't get profitable. These are all things we have to monitor. But if things stay on track, then everything points to the stock price going higher because the price to sales multiple has come down so much. Now, when Bill was at a price sales ratio of 81 compared to 18, not so much there. And that's the big lesson learned from all this, right? There is such a thing as a too high of a price to pay for any stock. And so if you go out there and you pay an 81 price sales multiple for one of the best growth stocks out there, it doesn't matter. The next few years are probably going to be pretty painful at the very least, right? And so the lesson learned, in my opinion, from these last few years is to just be more thoughtful and careful about buying at excessive valuations. But now I don't want to make the mistake of avoiding great stocks at much more reasonable valuations because the sentiment is negative or the price sales multiple still looks high compared to much slower growing stocks, right? Because now if they continue to grow, and we're at a price sales multiple of, again, 18 right now, even if they drop down to 8 from here by 2028, which is a pretty significant reduction, more than a 50% reduction still in price sales multiple, then you're still looking at an 8% annualized return for a 58% total return through 2028, which isn't great. That's not lights out, right? But this is factoring in 46% revenue growth per share, 33%, 25%, and then 18, right? Well, if this number is instead of 18, it's 22, and you get the same price sales multiple of 8, then you're looking at a 10% annualized return, which beats the S&P 500 historically, right? And so again, this is all going to come down to execution and what these numbers do. But I think we're at a point now where I'm comfortable owning these stocks and adding to them over time. And I think that they could do a lot better than this and grow in the mid 20s, maybe even 30% range longer than forecast. And all that takes is a couple years of that, and then you have significant upside in the stock, right? This is what I'm doing. It's not a recommendation for anybody else. So again, if you enjoy these videos, just do me a favor, like the video, subscribe to the channel. That helps us grow, and stay safe out there, right? We've got, if you're in the south or the southeast of the United States, then hopefully you're preparing for this hurricane and you're staying safe, all right?